There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
And now for high interest, a look at what's making headlines around the world. Israel carrying out huge bombing raids on Hezbollah targets near Beirut airport, alongside some ground attacks in southern Lebanon. Israeli officials said the strikes targeted the potential successor of the militant group. Iran's supreme leader called on the Arab world to unite against Israel and said Tehran would strike again if necessary. And over in the EU had voted to impose tariffs of up to 45% on electric vehicles from China. The decision brings with it the potential for a trade war between the bloc and Beijing, as China vows to protect its companies and threatens levies on European dairy, brandy, pork, and automobiles. 10 member states backed the vote, while Germany and 4 others voted against it. There were 12 abstentions. And U.S. dock workers agreeing to end a 3-day strike that paralyzed trade on the U.S. East and Gulf coasts and threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%, Katie.
Yeah, and of course, we'll be speaking about that with Acting Labor Secretary Julie Su in just a bit. But let's take a quick check on futures, because there's a lot to talk about. The S&P 500 up about 0.8% pre-market. The NASDAQ 100 Big Tech 1.3% on that index. Russell 2000, your small caps are the biggest winners today. And of course, that's against a backdrop of a bond market that is selling off quite mightily, Shomali.
BlackRock Chief Investment Officer of Global Fixed Income, Rick Rader, still back with us here. And I want to go back to a couple things you were saying before. Kind of this strength of the U.S. economy, yes, it's promising, but also you have all of these overlays. You look at the union deal, for example, wages higher in the report this morning as well. When you looked at employment across the board, you also have Brent flirting with that $80 level. Rick, why aren't you more concerned about inflation?
So I'd say a couple of things. One, you know, I think when people go back and think of where has an inflation been and what spiked inflation to these excessive levels, it was largely supply chain shock. It was logistics shock. You had a one-time 100-year pandemic that drove us to excessive levels. If you said to me today, we're going to run inflation 2.5. By the way, we don't think inflation. It's been decelerating. If you take the 3-month moving average, 6-month moving average, it's been decelerating pretty quickly. But if you said to me, we're going to stay at 2.5 for the next year or so, I wouldn't debate that at all. I think most of the inflation improvement has already happened. And, you know, our projections, James Sweeney, our economist, our projections show that we're going to stay at 2 or a little above 2 for a while. You know, could you pick up a little bit? It's possible. The point being, though, this is not scary level of inflation. And by the way, we've got a huge debt problem in the country. And so you want nominal GDP inclusive of inflation. You don't want it to drop that much. You'd actually, if you're in this 2.5, it's not scary. It's not devastating the economy in any way, shape, or form. So, but it's not excessive inflation, and I don't think there's any chance we're going back there.
Well, Rick, let's bring this conversation to the corporate credit market and use Bank, of course, your ETF as a jumping off point. You have an average rating of BBB+. You were saying before the break, of course, that when it comes to duration, where you want to be on the curve, there could be some opportunities arising in the front end. But when you think about the credit market, are you willing to take a little bit more credit risk here, or what's your thinking there?
You know, part of why I'm so excited about fixed income today, and, you know, quite frankly, we've lived in 3 years where equities have done extremely well. They're still doing extremely well because you've got a strong economy and you've got a technology boom in infrastructure, AI infrastructure, et cetera, that's pretty extraordinary. Credit today, when you have that strong an economy and you've got yields up here because the Fed is keeping the funds rate high, you're actually able to finance companies at levels on a real rate basis relative to a 2% inflation that are extremely attractive. Are the spreads attractive? Not really, But as long as I'm clipping that sort of yield, and if you took where we're lending companies money on a default adjusted basis, it's actually pretty darn attractive. And so we could debate what is the risk-free rate. Is a treasury the risk-free rate? We're going to issue an awful lot of treasuries the next couple of years. It's actually not that, certainly there's not that much high yield supply. There's not that much high yield supply in Europe. So I like lending. And one of the things I think is incredible, in my career, you've always had to, like, how do I get yield? How do I get yield? I got to buy some exotic EM to get some yield in the portfolio. Today, you can own AAA CLOs, you can own agency mortgages, you can diversify a portfolio and own credit and clip some really good yield. And that doesn't happen. We've had a couple of decades of very low interest rates.
Right.
That's pretty neat in an economy that is operating well.
Yeah, you don't have to reach too far for yield right now. Plenty of higher quality options here. I'm curious though, you're pretty upbeat about the economy overall, but of course, if rates stay high or if the Fed doesn't have to cut as quickly as maybe some people had thought, maybe before this report, what does that mean for the riskiest credits out there? You know, the CCC territory where maybe you don't play as much.
Totally right. It's not great. So, I mean, that's a balance. As long as you're clipping enough cash flow and the growth momentum of the economy keeps you afloat, you're in pretty good shape. But you're definitely right. One of the things that's interesting about credit today is there's part of the credit market that is, you've seen interest coverage numbers that have come down significantly. So do I need to, it gets to the point of, how much do I want to play? There's some restructurings we get involved in, some interesting things that are idiosyncratic. But gosh, I'd rather stay in high yield, single B in the U.S., in and around single B, double B in Europe, and then we'll make an idiosyncratic decision on some individual triple Cs. But you're very right in pointing both in the leveraged loan market and in the high yield market. There's part of the market that's got some stress, and rates staying higher certainly doesn't allay that.
It's interesting. I'm glad you brought this up. I'm glad Katie's been focusing on it too, because I think you look at where spreads are, and it shows a lot of complacency for the people who are playing around with credit risk. What's the cautionary tale here? How much stress might arise, especially as we probably are not going to see as many rate cuts as expected unless you see the economy turn much more meaningfully?
So, I've had my fair share of going through some volatility and cycles in different markets and stress. If you lay out, by the way, usually what created stress in the past doesn't create it in the future, and it's always hard for regulators to try and manage that because it's usually a different instigant that creates it. If you said to me, what is the risk going forward? You don't have, we think about high yield, you had energy risk, you have industry risk. What is certainly today, if you think about the go forward, geopolitical's the big one. Do you have some policy issue? What I think is the issue for the next 12 to 18 months, although I don't think it's a problem over the next year or so, is I think the debt problem in the country. When you start thinking about what do we do in the risk-free rate and the currency, if policymakers don't address the debt, the deficits, the debt service costs in the country, that to me is the big ogre that's sitting out there. But it's not today, particularly with a Fed that's generally cutting rates or is cutting rates, and you have people that haven't been investing, they've been sitting in cash. That will be okay for a bit of time, but that's the one that is in the back of my mind. You got to keep your eye on. It's part of why, do we need to own the long end of the yield curve?
Right.
Not really. Let's clip a lot of yield shorter to the belly of the yield curve.
All right, Rick, we have to leave it there. Always a pleasure to speak to you. Of course, that is BlackRock's
Thanks.
Rick Reeder. Have a great weekend. Now, coming up, Harley-Davidson dealers not feeling revved up, according to one analyst. That's in our Social Climbers up next. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, it's time now for Social Climbers. The companies making waves this morning. First up, shipping stocks, including Zinn Integrated, sliding after a strike by U.S. dock workers was suspended after 3 days. Analysts over at J.P. Morgan say that the quick resumption of port operations will weigh on a market that's currently oversupplied. Next up, Harley-Davidson getting downgraded from a buy at Baird. The analyst over there says that Harley-Davidson dealers are, quote, boiling over with frustration thanks to weaker demand, excess inventory, and caustic sentiment. He cautions investors to sit this ride out. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up with less than 4 minutes until those opening bells, we'll discuss the market moves with Greg Bottle. He is BNP Paribas U.S. Head of Equity and Derivative Strategy. That conversation coming up next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, we are just moments away from the start of trading on what's shaping up to be a very good Friday, at least in the markets. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and you can see the stocks behind me doing great right now. Of course, we got those NFP numbers at 8:30 a.m., adding more than expected on payrolls. The unemployment rate actually came down, and we haven't seen this in a while, but upward revisions to prior jobs number. Wall Street is celebrating right now, of course, and you can see that enthusiasm with the clapping going on behind me at both the NASDAQ and the New York Stock Exchange. Of course, October had been a pretty soggy start, but maybe the narrative is going to change today. Let's take a look, of course, at the major indexes, how they're faring just seconds into the trading session. You can see the S&P 500 currently up about 0.8%. We're going to be talking about all-time highs again. You take a look at the NASDAQ 100, big tech leading the charge here, 1.2% higher on big tech, but don't count out the small caps. The Russell 2000 currently up about 1.5%. Of course, those smaller companies really celebrating the strength that we're seeing in the labor market. Let's take a look under the hood, though, because there's one bad news story, and that's Spirit today. It's plunging as months of talks with bondholders failed to result in a deal. That is according to sources. The airline, of course, trying to restructure its debt and avoid filing for bankruptcy. You can see shares currently off by almost 35%, Shanali.
Some more of the good news stories over here, too, Katie. We're watching Summit Therapeutics surging after it said that the FDA will fast-track its lung cancer drug for use in chemotherapy. You have Summit now up more than 8% as the market opens. But another bad news story to look at, Rivian has cut its production guidance for the full year due to supply shortages. Rivian shares at the open down more than 4%. Let's take a closer look at Rivian with Bloomberg's Ed Ludlow. Talk us through it, Ed.
The drop at the open is not as bad as it was in the pre-market. At some point in the third quarter, there was a significant supplier issue that got worse. We don't know what that is. We don't know if it relates to a specific part. We just know that it relates to the Enduro electric motor or drive unit that Rivian manufactures in-house. And it's a really kind of change in the picture for this EV name, because if you think about it, the production guidance of 47,000 to 49,000 would actually represent a drop of 18% from what they managed to build last year. This was a company that was kind of on the up a little bit. They're expecting to build, prior to this morning, 57,000 units this year, and they continued to demonstrate teething problems that they can't get past.
And of course, marry this together with what we learned from Tesla earlier in the week, of course, missing its target when it comes to third quarter deliveries. You actually have Tesla shares up a little bit right now, but actually down 5% for the week. How do these two stories wrap together?
Oh, well, in Rivian's case, I think it's not an industry problem. I think with Rivian, it's a Rivian problem. They're not being that open or transparent or detailed on what's actually going on with this specific part or where the issue is stemming from. You know, Tesla were not prescriptive on their miss. I go back to the granular detail that we discussed on this program, which is that 3 and Y, which are the volume models that Tesla makes, came in above sell-side expectations. That other bucket, which includes Cybertruck X and X, X and S, came in below expectations. Both names, Rivian, which is a niche, lower volume player, but Tesla specifically, have suffered in a higher rate environment because it's put a premium on electric vehicles. Tesla has had the lever of heavily incentivizing consumers that Rivian doesn't have the luxury of doing. It burns too much cash, can't do it. So it will be interesting to see if there is a big picture industry theme here, but I think Rivian's problems are their own.
All right, Ed Ludlow walking us through the nuances going over in EV land. Really appreciate your time. You can catch Ed on BTech, but stay right here because we're going to broaden out this conversation right now with BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Bottle. Greg, great to see you again.
Good morning, thank you.
Okay, so green on the screen, of course, the labor market holding in there, the Fed cutting into strength. Seems like life is pretty good right now.
Yeah, I think if we're going to get a Fed cutting cycle and it's going to be accompanied by strong data, the likes of which we've seen this morning, then I think it's a recovery story for some of the cyclicals. So you see in the index space, it's the small and mid caps leading today. That's consistent with the data.
Well, it's interesting. Even if you have the expectations for rate cuts declining here, that movement that we've been watching in the Russell 2000, it's not what you've been seeing at other moments where we have seen that similar concern. Does one day start a new trend, or is this something to be wary of?
No, not at all. So I think we have to be nimble and mindful of the fact that we've had a very rocky ride over the last 3 months, where we had, the Russell rally massively back in June off a weak CPI print. And then we saw some precipitous declines when the labor market data and the ISM were weaker. And now we get a better message today. So I think the message from us is that there's a wide distribution of returns and vol ahead.
Well, let's get philosophical here. Let's step a little bit back and talk to us about the psychology of this market. Is this a tactical, sort of opportunistic market, or is this sort of a stick to your guns, long-term, follow your narrative market?
I think depending which parts of the market you're looking at, there might be different stories where you have to be nimble, but then there might be some of those themes which do run much further. So at the moment, we've got a lot of uncertainty. We've had some pretty massive moves come out of China. We have the US election still to come. Q3 earnings really gets into full swing next week. And obviously the macro data has been at a bit of an inflection point where people are trying to work out, is this slowing too fast, or is this actually a benign soft landing with a cutting cycle?
Well, let's get specific here. I mean, where do you see the opportunity and the need to be nimble when you take a look at certain parts of the market? And where is the story roughly the same, would you say?
So I think where we can be nimble is looking at where there are different messages from different parts of the market. So one of the things that we highlighted 10 days or so ago was that we'd seen almost every cyclical sector rally in Q3, apart from the oils. So we think we can find where there are some unloved parts of the market and a potential for convergence, really. It's hard to see things like the banks, the home builders up between 15 and 20%, and a sector like the oils just remain in the doldrums.
So how do you play the market from here? Because up till now, the S&P equal weight has been a place that many investors have been looking for that rotation trade. So what do you like better? The SPW, the S&P equal weight, the S&P 500, the NASDAQ 100. You're seeing just a tear in tech stocks after all of this movement. What do you like?
So I think that there is probably the most opportunity, the fattest right tail within the small and mid caps, but there's also probably some of the largest risk there. So I think that is the index that has been most macro sensitive.
The Russell.
Yep, it's been most macro sensitive, and it's been most sensitive historically to the elections. So we think there's potentially the most upside there, but also some of the most risk. So we've been talking about using optionality as a way to kind of navigate that risk-reward profile.
You know, until this point this week, of course, this is tremendous optimism this morning off the heels of this jobs report, but it's been a really rough week. A ton of geopolitical conflict. It's been a choppy trade. Oil prices rising once again. The VIX rising back to 20. It's not been as high as we've seen this year, but there's clearly some fear under the surface.
Yep.
Where do you hedge?
So I think the interesting thing about the VIX, just touch on that for a moment, is where we are relative to the broader equity market. Because the VIX has spiked during equity market sell-offs, but finding ourselves close to all-time highs in 20 at the VIX is very anomalous, particularly when you look at how much the S&P has moved recently, which is not an awful lot. So I think in terms of optionality, we've been talking about trying to use options to express directional views. So the VIX is a more pure volatility play. Do I think the VIX is necessarily going higher? Maybe not, but I think there is value in using optionality to play directional trades. So one example of that is if we go back to the 2016 election, we saw some huge moves in things like the Russell, much more than was implied by the options market. But that wasn't necessarily a story of higher close-to-close volatility. It was more that there was a big trend and a fat right tail.
Well, let's build on that a little bit. Using options to express your directionality. Some people might say that seems like an expensive way to just go long, just versus just actually buying the index. I mean, what benefit do you get by tapping the options market to express your views right now?
So I think if you have absolute conviction and you want to be purely long delta, then you're probably right. You're paying a premium for that added optionality that you get from using the volatility market. But when we look ahead to whether it's earnings season or the US election, if you don't have conviction of who's going to be in the White House, whether it's divided government or a sweep, then you could say that there is some value, we certainly see it, in embedding optionality into those trades.
But are the days, to Katie's point, of setting and forgetting an S&P 500 ETF a little bit over at this juncture, given what we're seeing?
That would be a huge call.
Yeah, well, I think that if you're able to be nimble and navigate some of the rotation that we've seen, there's alpha to be extracted there. I think if you're able to navigate the options market, there's extra returns that can be navigated there. It doesn't mean that you can't make expressions through broad-based ETFs, but I absolutely think the last 3 months is evidence that there's opportunities to rotate under the surface.
Greg, Stay with us. Of course, that is Greg Bottle. We're also going to take a look at some things moving under the surface because there is a lot of movement broader than the equity market indexes. We're looking at American, Frontier, and JetBlue shares surging more than 10%. That's all as Spirit Airlines is sinking. Remember, Spirit has had months of talks with bondholders failing to result in a deal, according to sources. The airline is trying to restructure its debt and avoid filing for bankruptcy. Just incredible movement here. American now up almost 9%. Frontier just surging more than or nearly 20%. JetBlue up 13%, but Spirit still down by more than 34%. Now coming up, Morgan Stanley getting an upgrade as big banks get ready to report results later this month. Starting next Friday, those numbers come out. We will be all over it, but stick with us. More ahead. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks right now because we are ripping. If you move up the size tiers here, the S&P 500 currently up about 0.8%. Big tech up about 1.2%. That seems pretty good, but then you take a look at the small caps. Your Russell 2000 currently up about 1.5%. Of course, there's a lot of daylight between now and 4 p.m., but for right now, looks pretty good. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, HSBC upgrading Morgan Stanley to a buy, saying that the bank's period of underperformance against Goldman Sachs and the broader market might be ending. Next up, Bank of America cutting Warner Music to a sell. The firm cites a stretched valuation and highlights disappointment in the company's emerging platforms. And finally, we have Truist Securities saying that Dine Brands, that is the parent company of Applebee's and IHOP, it's no longer a buy. The firm is downgrading the stock to a hold after concerns about slowing sales trends, currently down about 4%, Janali.
And we're back here, Katie, with BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Bottle. And, you know, big sigh of relief in the market. You see it in the price movement after that jobs report. Of course, employment holding strong. Now it's time to turn the page. Let's look to the next set of catalysts. What is a bigger deal ahead? We have an election before that next Fed meeting. Is there anything else in between that could shift the narrative around equities?
Yes, I think earnings season is the biggest catalyst that we see on the radar. So we've had a couple of off-cycle reporters report recently, FedEx, Nike, not necessarily glowing reports. We move into next week, and next Friday it really gets into full swing with the banks. So I think that Q3 has historically been one of the most important reporting seasons, producing some of the largest returns for equities, because you tend to get a bit more of a glimpse into guidance and what 2025 might hold.
Let's talk a little bit more about the upcoming election. Of course, we want to get into earnings as well, but when it comes to the election and how you prepare your portfolio for it, speaking to you with, of course, your equity derivatives hat on, there was an interesting story on the terminal a couple days ago about how basically people are waiting to hedge the election in the options market. Is that the right route to take here, or is it time to start?
Well, for us, it's more level opportunistic. So if you go back to the 2016 election, what you saw was some pretty wild price action in the options market. If you look at the VIX or the VIX futures or VIX options, it was very benign in the run up to the 2016 election until you got 2 weeks out, and then some of that hedging activity exploded. So for us, it's more about picking the right levels. That's why our thesis is buy the dips and optionality. Be price sensitive, but try and find those opportunities to hedge. Don't just wait mechanically until the last week or two.
So statistics was one of the favorite things that I liked as a total weirdo, as you know, Katie. There's an interesting chart in that note that Katie's talking about with the distribution of outcomes. And I think that's really important here. And it seems like you and many others believe that the left tail event here is a blue wave, but more likely, still not too likely, is a red wave. What would either of those mean for the market?
So I think when we think about what elections mean for kind of economics and society at large, you can talk about a whole range of things. But when we talk about equity markets, it can be quite simplistic. Do you think you get forecast upgrades or downgrades off the back of this? So corporate tax rates is the biggest, most obvious thing. We saw it back in 2016, Tax Cuts and Jobs Act. You got corporate tax cuts, you got massive earnings upgrades, and the market went up. So simplistically, if you think in a red wave, you get tax cuts, it's going to be more market. It's going to be more market kind of positive, constructive. If you think a blue wave involves tax hikes, then it's probably going to weigh on the equity markets, which is why a divided government one way or the other probably has far less beta impact for the indices.
All right, so keep an eye on the down ballot races. Before we let you go, you know, we've spoken a bit about fat tails, of course, and I'm curious, I mean, when you look at all the possible events out there, all the possible risk factors from the economy, the Fed, the election, what's going on overseas, those hot wars developing right now, I mean, where is the biggest potential for a black swan?
I mean, the black swan is often the thing you don't see coming. I think when we look at the kind of known unknowns, if you like, it's the idea of having a kind of a continuation of events. So if you were to see the labor market really crack, we had the SAM rule triggered recently, you were to have a blue wave, that's how you get to the fat left tail. I think for the fat right tail, it's this idea of the Fed cutting, the labor market being pretty strong, and then potentially getting a Republican sweep and tax cuts. And I think it's small and mid caps to come back to that part of the market we were talking about at the top of this, which is most sensitive to all of those factors.
All right, tying it together really nicely. Greg, it's always great to see you. Have a great weekend when you get there. That is Greg Bottle from BNP Paribas. Now coming up, Acting Labor Secretary Julie Su joins the show. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. The U.S. added 254,000 jobs last month. That was beyond all estimates to the upside. Let's unpack it now with Acting Labor Secretary Julie Su. Secretary, it's great to have you with us. Of course, we have a lot of good news to talk about, from the upside surprise on payrolls, of course, the unemployment rate dropping, and of course, that port strike suspension. Let's start with the labor market, though, because as I mentioned, of course, beyond all estimates to the upside, and then you take a look at some of the details on the demographic level, even more good news when it comes to white, black, and Hispanic unemployment. Where do you see the greatest source of strength? What were some of the factors driving those improvements?
I think this has been the story of the economy under the Biden-Harris administration, frankly. Many people predicted that we would not be able to do this, have this kind of recovery, and have incredible job growth while keeping the unemployment rate low, while bringing down inflation and interest rates. All of those things are now happening. We saw growth in this last month in healthcare. We saw it in restaurants. We saw it in local government. All of these things translate into quality of life, right? It's not just workers out there doing jobs. It's potholes are being fixed. It's increased public safety. It's people getting back to normal, right? Remember, 4 years ago this time, a lot of restaurants were closed. Now it's the industry with incredible growth in the September report. It was back to school 4 years ago, back to Zoom, because we were in the middle of a global pandemic and there was no national strategy to get it under control. Right. 4 years ago, kids were being told no trick-or-treating for Halloween. We are in a very different place right now, and that is in no small part because of strong leadership and economic policies that have helped to fuel an unprecedented economic recovery.
And Secretary, as you know well, a very strong report overall. If you were looking for some weakness, you would find it in the manufacturing sector, of course, shedding another 7,000 jobs. That was slightly better than estimate, but a contraction there nonetheless. And the downward revisions there were actually lower. So what is the administration doing to address what's going on in the manufacturing sector?
So here's the story of manufacturing. President Biden and Vice President Harris have been saying since day one, we believe we can make things in America again. We can open up factories that were shuttered in the last administration. I visited some of those, factories where people had to leave their community, leave their families to go find jobs elsewhere, that are being opened up again. But it also takes some time to reverse the really decades of disinvestment in our manufacturing industries. Now, we're making historic investments now, and that's really showing up in the construction sector. And you got to build the manufacturing facilities before you can hire people into them. And so this is, even this jobs report, as great as it is not a declaration of victory. It's a declaration of progress. We are making significant progress, and we need to keep up that trend. We need to keep up that work. Manufacturing jobs have grown, but they're going to grow more as we keep investing in America.
Well, let's talk, of course, about the other piece of good news this morning, and that is that the 3-day strike at East Coast and Gulf Coast ports has ended. The contract extended through January 15th. I know that you were heavily involved in the negotiations. The New York Times reporting that you were in New Jersey yesterday, of course, meeting with the unions. Talk to us about how it happened in the end. What did you do? What did Secretary Buttigieg do? And what did Joe Biden do?
Look, this is another example of many in this administration of just how powerful and effective collective bargaining is. When workers have a voice at the table, when they have a union on the job, when they can come to the table, sit down with their employers and talk about what's good for them, what's good for their company. It's better for the economy, it's better for the nation. We've seen that from auto workers to airline flight attendants, from hospitality to healthcare, and now at the docks as well. And this was a situation where longshoremen who do difficult and often dangerous jobs worked through the pandemic, strapped the country on their backs, and have helped to fuel record profits. Shipping carriers have made tens of billions of dollars in profits over the last few years. Again, that's partly because the economy as a whole is strong.
Right.
So when the economy is strong, everybody benefits. And this is an example of how when workers have a voice, when collective bargaining happens, workers can get their fair share. And at the end of the day, when I was in New Jersey, when this was about to happen, the longshoremen were saying, let's get back to work right away. They were ready to go back last night. That's because working people understand how important they are, they understand their contributions, and they are showing up every day to make them. And we are really happy to see them getting their fair share.
Well, Secretary, it's a victory, but it's a partial victory because we're talking about an extension until January 15th. So what is still yet to be resolved here between now and January 15th?
Yeah, it's such an important point, right? Collective bargaining is a process. And you heard the president say this. I'm grateful to be in a cabinet of other people who are fully committed to the idea that we have to trust the parties, and now that they're coming back to the table, they're going to deal with all of the other issues that are on the table. And I have great faith that they're going to get to a fair contract and be able to move forward together to the important work of our supply chains and helping to continue to make sure we're the strongest economy in the world.
So you have great faith here, but I mean, is it possible that we're going to see this fall through in January, that we're going to see a return to the picket lines when you think about some of those issues that are still yet to be resolved?
Well, the vast majority of contracts, when they're being negotiated, end in a contract. I've been all across the country, both celebrating those outcomes and urging the parties to stay at the table. So the ones that we hear about are ones that become, more contentious. Now, a lot of times that is because workers for a long time have been falling behind. There have been, the economy in the last administration was not as strong as it is now. The contract for these longshoremen was negotiated in the last administration. Today, the economy, as demonstrated by the jobs report, is stronger. It's different. And so we believe, now the parties have resolved one of their big issues. The best way to get this done is for them to sit down together, and that's exactly what they're going to do.
All right, we really appreciate your time. As always, of course, know it's a busy morning for you. That is Acting Labor Secretary Julie Su. Meanwhile, let's take a look at the impact that jobs report is having in the market, because it's fueled a rally, but it's coming back a little bit. You take a look at the S&P 500, it's still higher, but only by about 0.4%. We were higher by about 1%.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we've provided ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to speak with Austin Goolsbee. He's Federal Reserve Bank Chairman of Chicago. He's going to be sitting down with Bloomberg's Michael McKee. That's going to start in just about 2 minutes' time. Alex Steele is off today. Not to worry. Emily Garfeo is sitting in for Alex. Emily, thanks so much for joining us here. I mean, a heck of a day here. The jobs number came in way stronger than expected. So we're going to break that down with some smart people. Joni Biley, Division President at Employee Bridge, she'll be joining us. Ben Emmons, Chief Investment Officer and founder of Fed Watch Advisors. What does a print like today do for the Fed? Maybe taking that 50 basis point cut off the table. The market seems to be now discounting 25 basis points at the next meeting. Lee Klaskow is going to join us, Bloomberg Intelligence Logistics analyst there. The U.S. dock workers agreeing to end a 3-day strike, push off those negotiations. They'll be able to have them for the next couple months until January. So hopefully they'll be able to get something done. But that's good news on the global shipping front because that was day 3 of that strike. So good to get some resolution there. Again, coming up in just moments, we're going to get the feel for Austin Goolsbee and how he views this economy here. Again, they're very strong print here on non-farm payrolls. Austin Goolsbee, Federal Reserve Bank of Chicago President and CEO. He sits down with our own Bloomberg's Michael McKee, and we'll get a sense of his view of this economy. Let's take a listen.
Yes, we're going to turn our attention now to the Federal Reserve and Chicago Fed President Austin Goolsbee, who joins us now to talk about the numbers that we've just gotten and what it may mean for him and what it may mean for the Fed. Good morning, Austin. Thank you for being with us. And you know,
Mike, good morning to you.
You know where I got to go first. You're the one that said we need to cut significantly in the future in order to keep the unemployment rate from rising. Do you still feel that way after the unemployment rate fell, and if it was rounded down by 0.02 of a percentage point, it would have been 4%?
Yeah, look, my statement was about over the next year and what's the long arc. This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report for the economy, coupled with the finding out that the port strike is not going to be an extended matter, and that at least for months this is not going to be an issue. Those are two pieces of very good news for the economy. I still think, as a central bank, you don't want to react too much to 1 month's report, but the revisions of the previous month's upward in jobs growth and the unemployment rate coming down, if we get more reports like this, I'm going to feel a lot more confident that we are, in fact, settling in at full employment.
I know this has only been out now for a little more than an hour. Has your staff or you looked into it enough to try to figure out why the report was so good?
Well, I mean, you're getting a lot of the estimates of GDP growth still continuing to suggest that growth remains robust. So I think the first thing about job growth is that it's tied to how the economy is doing. So if you get strong reports, that's likely to be correlated with strong GDP growth. As I say, we've got some cross currents, and we need to take the longer arc. We had previous to this one 2 disappointing numbers. Now we have a superb number, and we need to keep monitoring it. If we get more reports like this, as I say, I think we should have more confidence that we are, in fact, settling in at the landing spot that we want from a dual mandate perspective. Inflation has been coming in right around 2%. If the unemployment rate is going to settle down something just over 4%, you would love to freeze frame that and put the picture on the wall.
Does this perhaps change the emphasis a little bit for the Open Market Committee? Jay Powell saying at his last news conference that the risks to inflation and to employment are about balanced, but we're more worried about employment. Do you have to add more weight on the inflation side now?
I don't know. I agreed absolutely with what Chair Powell said at the press conference, that we went through a period where getting inflation down from its extreme highs was the order of the day. That was really almost the sole focus. And now, when we had two disappointing jobs numbers, it made clear we're in a balanced environment with balanced risks. That we got a superb number, I'm extremely happy with, but let's not lose sight of what's the longer thread. Over the next year, if you look at the SEPs and the dot plot, a large majority of the committee feels that conditions are going to improve on inflation, that we're going to keep getting closer to 2% target, that the unemployment rate is going to stabilize at full employment, and that rates are going to come down a lot over the next year, 12 to 18 months. And that seems quite appropriate. If you are in a good spot on the dual mandate, that inflation and unemployment are where you want them, you just got to be careful keeping the rates as restrictive as they are, so far above where committee members think they need to settle. If you're not careful about that, you will lose the freeze frame that you want on either inflation or on employment. And if you look at expectations, there are some signs that inflation might undershoot the 2% target. And we want to be mindful of that, too.
Well, let me ask you, if you're looking at inflation that might undershoot the target, you think you're too restrictive, but yet we're seeing growth of 3.1%, according to the nowcasters, and we're seeing a 254,000 jobs print. Are we really that restrictive?
Well, you have cross currents. That's what I'm trying to emphasize. There are pieces of strong data, and then there are pieces of weakness. And if you just look at the dot plots, where does the committee feel that it will be appropriate for rates to settle? It's a long way below where it is now, if you think of that as what the R-star or neutral rates would be. So that is the sense in which, over a long period, we need to get what's the through line, and we need to try to maintain conditions very much like what they are now. So if we get more reports where GDP is strong and the unemployment rate is staying in the 4.1 range or even going down, then we're going to have a lot more confidence that we're hitting the target that we want.
Well, do you think the neutral rate is higher now? Where would you put it, given the strength of the economy that we see?
It's hard to say exactly what it is. I think it is definitely higher in my mind than the zero where we were for a lot of years before COVID. If you just kind of look at those dot plots, the settling down range, the bulk of it looks to be kind of in the 2.5 to 3.5 sort of range. We're still a ways off from having to sort that out, I guess I would say. If you're at 5 and people think you're going to end up between 2.5 and 3.5, you have both time and runway to figure out where the settling point is.
Well, the narrative coming into today was that companies weren't firing people, but they weren't hiring people either. And obviously, that was not correct in the last month. What are you hearing from companies in your district about their employment plans?
A lot of we have 30, 35 different business roundtables throughout the year where we go and contact executives, community leaders, community development, financial institutions, and we ask, what is the experience on the ground? And we have a lot of business contacts. Mostly what I have heard has been of the more of the same, steady, not going down, but not really accelerating. So it'll be interesting to see as we come through to the end of the year here, if the GDP nowcasts are correct, that growth is going to be higher than trend, let's call it, higher than expected. Will we start to see that in the reflected in the comments for the Beige Book and others? The one thing is we're more intensive in manufacturing here in the Midwest, and there is, as you know, a bit of a shift back of consumer spending towards services and away from physical goods as we fully come out of the pandemic. So that weighs down economic activity a little bit in the manufacturing sectors. But you mostly been hearing steady as she goes, not reacceleration and not a real drop-off.
Well, then, if it were up to you, I know you're not a voter this year, you will be next year, does this report change the idea of how much the Fed might want to cut in November? And is it possible we get another report that's good, even if it's not this good, that you just stay on hold?
Well, you know I don't like pre-committing before we've had the discussions at the meetings for what the rate should be. Over the longer run, which is what a central bank, the hardest thing the central bank has to do is get the timing exactly right when there are moments of transition. So this isn't an easy process. There's definitely an art to it. If we get more reports like this, and I'm going to have more confidence that we are settling in at a full employment, low inflation kind of a baseline. If you take the broad job market, I don't want us to overreact to 1 month's report. We've seen, if you take vacancies to unemployment ratios, if you take the hiring rate, the quit rate, a series of labor market indicators, they suggest the job market has been cooling, but the level is quite favorable. And if we can settle in at this level and things not get worse, well, that would be a very, very comfortable outcome.
Well, right now we're looking at, as you mentioned, somewhere between 150, 200 basis points of additional reduction in the Fed funds rate by the end of next year. Do you think that if we settle in, as you say, that would be significantly less?
If we have improving jobs numbers and GDP growth of 3% from now till whatever, I think the first thing we'd start doing is say, is the rapid productivity growth that we've observed for the last year and a half, are we in a new period like what we saw in the mid-90s? And if so, we're going to have to recalibrate what is expected potential growth. Well, if we get... Yeah, go ahead. You want more on that?
Well,
I was going to say what the ultimate R-star neutral rate that we're going to settle down at depends a lot on what you think that potential growth rate is. So if productivity growth keeps booming like this, that does imply a faster growth rate. I think that does imply, just in the economics, that there would be a higher R-star. But in a way, that would be the glorious version. It's only because the economy can handle it.
All right, let me ask you one last question here. Did we hit a soft landing?
Well, you know, the problem with the analogy of the soft landing is that it connotes stopping. The economy never stops, so there's never a mission accomplished. We hit what I called the golden path already in 2023, which was we got inflation down substantially, almost as much as it has ever fallen in a single year without having a recession. That's basically never been done before. If now what we're going to be able to do, if we could keep unemployment in this between 4 and 4.5% with inflation hovering around the 2% target, that's exactly what the intention has been all along for the Fed, and everybody should be happy if we can pull that off.
All right. Our thanks to Austin Goolsbee. He's the president of the Federal Reserve Bank of Chicago. We'll see on November 7th what the Fed does next. Next employment report is November 1st.
All right, that was Austin Goolsbee, Federal Reserve Bank of Chicago president and CEO, speaking with Bloomberg's Michael McKee. Emily, it feels pretty good, I think, for that Fed member about this economy. We've got a strong print on the labor market. The economy is still putting up some solid growth. Inflation is moderating, so I think from the chairman of the Fed president out of Chicago, that's pretty solid.
Yeah, he said we must try to maintain conditions much like they are now. Overall, they have time to figure out where rates will settle. I guess that's answering the question about where is the neutral rate?
Exactly. So looking at the WIRP function, going into the day, there was a pretty good likelihood that a 50 basis point cut would occur at the next meeting. That's been kind of taken off the table here. Mostly the market's pricing in a 25 basis point cut here at the next Fed meeting. So that's how this jobs data has impacted kind of the expectation for rates cutting. Let's dig a little deeper into that labor data we got today. We're joined by Joni Biley, Chief Workforce Analyst she's also the chair of the American Staffing Association, so we appreciate chatting with Joni every time we get these jobs numbers. Joni, what do you make of this number? The print right across the surface looks really solid.
Yes. Well, hello, Paul and Emily. Great to be with you today. Really interesting report this morning. The headline number looks very strong, over 250,000. And it's interesting listening to Austin Goolsbee talk about, the numbers and how this might relieve, a lot of pressure. But I have a little bit of a different take when you dig into these numbers. Most of the jobs that were actually created in the month of September were in the healthcare sector and then also in the leisure and hospitality sector. Those two sectors alone had about 160,000 jobs created. So then if you dig into the details here, we can see, construction was good, 25,000 jobs created. The government added 31,000 jobs, but then we're not seeing robust growth in many of the other sectors. And so I think that headline number can be a bit misleading when you look at the actual data that is in the establishment survey.
So what then is it telling you about the current state of the U.S. economy when you do seem to have noticed this kind of maybe distorted picture of the labor market, at least just looking at the numbers and the data that we got this morning?
Yes, I think there are some sectors that are doing well. I'd like to see growth come back, in the manufacturing sector, stronger numbers in the professional and business service sector. We still saw a decline in September of almost 14,000 jobs in the temporary help staffing sector. And that's something that I always pay attention to because it's part of the industry that I'm in. So, Emily, I think what it's telling me is that we're still in a soft job market. Though some of these indicators look good, and I do believe, Austin did mention it, there are other indicators that are showing we're still in that soft job market. Maybe we've gotten to a point where we do have that soft landing and things will start to improve over the next few months. And I certainly hope that that is the case. But I don't think that we are out of the woods just yet.
So that's a more cautious take than we've heard throughout the morning here, Joni, just in terms of this market, as you characterize the labor market as maybe a little bit softer than it appears here. What are people missing, do you think?
Well, I think if you look at the report, and seeing almost 80,000 jobs come back in leisure and hospitality, those jobs are lower leveled skilled jobs and lower wage positions. So what we're not seeing come back yet are the higher skilled, more professional positions. Certainly in the healthcare sector, that remains very strong, but we're not seeing jobs like in accounting and finance and really that STEM field, which there is a strong, demand in the future for, the skilled jobs in science and engineering, but we're not seeing a ton of job creation in those sectors right now. I also was very surprised that when you look at, some of the numbers in like transportation and warehousing, those numbers were very soft, which tells me we're going into the retail season. We're not seeing, the companies really get ready for a strong, retail holiday season. We're also seeing employers that normally hire this time, of the year and start to ramp up for the holidays. Their projections are a bit softer of the amount of people that they are going to need. So that's where I think I take a little bit more of a cautious approach. I'm not saying that we're going to fall off a cliff by any means, but we still need, a few more months of job growth and really start to see some of that growth come from other sectors, in addition to healthcare and leisure and hospitality.
All right, Joni, thank you so much for joining us. We really appreciate getting your perspective when we try to break down some of these jobs numbers here today. Joni Biley, she's a division president at Employee Bridge, and she's also the chair of the American Staffing Association. So a great voice to speak with on these important job days. All right, let's get a reset of these markets. We'll go to Lisa Mateo for a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Interactive Brokers Portfolio Analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/freepa. All right, stock indexes erasing early weekly losses. Right now, they're advancing after the September jobs report crushed expectations. 254,000 jobs added last month, the most in 6 months. The prior 2 months revised higher by 72,000. The unemployment rate fell to 4.1%. Hourly earnings increased 0.4%. The Fed's Austin Goolsbee also saying there's still time to figure out where rates will settle. So let's see where the numbers are right now. We have the NASDAQ up about 0.5%, 92 points, 18,011. The Dow up 0.2% at 42,130. The S&P 500 up 0.3% at 5,719. Where is the biggest boost coming from? If you go to the IMAP feature of your terminal, you have the 11 major industry groups. A nice boost from consumer discretionary. A little further, we see automobiles, components, then automobiles and car manufacturers. The top, we see Tesla, followed by General Motors and Ford. All right, let's head to the bond market. The 2-year yield, 3.86%, up 15 basis points. The yield on the 10-year, 3.95%, and that's up 10 basis points. Global shipping stocks slumping now that the U.S. dock workers strike is on hold. You have Maersk, their shares down 5% in Germany. Zim Integrated Shipping, that's down about 12%. And finally, shares of Spirit Airlines down 27%. The carrier and creditors struggling to reach an agreement. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Over to you.
Lisa Mateo, thank you so much. We appreciate it. Emily Grafeo, she's sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Live Radio, and that's where you will find us. Again, on the labor front, the print here, as Lisa was just reporting, very strong jobless claims or print for the non-farm payrolls today, much better than expected. Some good unemployment rate numbers as well. Let's check on Ben Emmons, because we want to see what this means for the Federal Reserve. Ben Emmons is the founder and chief investment officer of FedWatch Advisors, joining us from Washington, D.C. So, Ben, again, a strong labor number today, non-farm payrolls. How do you think this Federal Reserve is going to interpret this data?
Hi, Paul. Well, listening to Austin Goolsbee, he does continue to indicate there are more cuts coming, right? I think they feel that although these could be sometimes outliers on a monthly basis, it's interesting it still happens because of the pandemic effect with all this distortion in the household versus establishment survey. It's nonetheless a labor market that does show deterioration. Like if you look at the median duration of unemployment has now risen to 22 weeks. That's the highest since, I think, 2022. And if you take, the percentage of people, of 27 weeks or longer out of work, that's now at 23% of total employed. So there's some underlying deterioration. I think this Fed is keen on bringing that back in and trying to control for the worsening of the picture, given the restrictive stance. So I think the Fed will continue to look at this saying, we have room to cut. This is a good labor market, but we can cut rates because we just have very restrictive policy to keep the labor market in good shape.
I'm wondering if, a lot of people talk about how monetary policy happens and comes with a lag, and yet we're only about a month after the first rate cut. So Ben, would you say that the rate cut is already working, or is something else also driving the strength in the labor market right now?
So I think it's partly the signaling effect from rate cuts. If you step back, actually going to the June-July period when all that softness started to come through and the Fed speakers started to also look at that and start to talk about rate cuts, all that signaling happened. If you now look at the ISM data that's coming through now, including regional data, you see all the forward-looking indicators some sort of a turn upwards, right? And that's new orders and inventories and that sort of like cyclical indicators. And again, it brings me back each time to Bostic, who was so outspoken on this, saying that they, in their surveys with local businesses, they got a lot of feedback like, okay, Fed, if you're going to cut rates, we're going to see a lot more sales activity, a lot of things happening. And I think that may be a reason, right? So in surveys, it shows up, whereas this employment report itself, I was talking to your economist, Anna Wong, about this. Like, there's some alternative data out there that indicated that may have been a really strong month. But it could be because of just a lot of shifts happening underneath. So I think the basis points of cuts that we just had, that is just hitting the economy as we speak. But that may take some time before it truly works through. Why this Fed, I think, is not deterred cutting rates from here, despite the strong number. But the signaling of cuts is interesting. That is coming through the forward-looking indicators. Yeah.
Hey, Ben, we kind of came into this morning with a reasonable likelihood that 50 basis points was on the table for the next meeting. I'm looking at the WERP function here, and that seems to be kind of off the table, seems to be pricing in a 25 basis point cut at the November meeting. How do you expect the Federal Reserve to proceed over the next 3, 4, 5 meetings as we get into next year?
Yeah, these probabilities are so fluctuating, Paul. Like, I looked at that too. It was 30% before the number, now dropped to 7.5% for 50 basis point cut. So it is definitely sensitive to anything that's stronger of data, right, versus weaker of data. I think that's the mechanics of the markets. So the Fed will ultimately come down to back what they did at this meeting. We'll get this minutes out in a couple of weeks. I think they just continue to look at like where the policy is in broader sense of how restrictive it really is. And look, since the last 2 CPI reports, PCE reports, the real interest rate, the Fed funds rate, has only risen a little further from here, right? So it's gotten even more room to cut rates. We get CPI on Wednesday, I believe. It's probably going to be not as strong of a CPI data either. So that real Fed funds rate remains quite high, drifting towards 3%. I think that is what they're looking at to say we can take some off. So we'll keep cutting rates until at some point inflation does show some stabilization, maybe turning higher, and you're seeing the economy really accelerating in terms of growth.
What does that mean for investing in bonds? I mean, today I'm looking at, the 2-year up 15.8 basis points, the 10-year up 10 basis points. I guess those expectations that maybe the Fed is not going to cut as much, is that bad for people trying to make money in bonds here?
It could be because, like that, when we were at roughly the lows on the 10-year, it was somewhere like 365 or so a few weeks ago, and we're now almost back to 4%, right? So call it 35 basis points of change. The interest rate sensitivity of bonds is still really high. I noted from the index duration, right? So sensitivity of interest rates has climbed up again since we had this decline from interest rates from the spring, from April all the way into the summer. And so it does show that if you're getting a little move in rates higher, you immediately get these accruing losses. So be mindful of this volatility that's basically caused by this interest rate sensitivity. The short end of the yield curve will always remain a bit more attractive because the yield curve is slowly normalized, but not as much, but there's still much more yield there. That's been said a lot, but I think I stay on that view too. But bonds in itself will remain basically at the whim of this data movement. So there's volatility in bonds that's higher than what we had pre-pandemic, which makes it not always that easy to just go all in bonds. In that sense, I would be more careful with long duration bonds here.
All right, Ben, thanks so much for joining us. Always appreciate getting a few minutes of your time. Ben Emmons, Chief Investment Officer and founder at FedWatch Advisors. All right, so we had a good news story on the labor front today. We also had some good news last evening, also on the labor market. We've got the U.S. dock workers agreeing to go back to work as talks extended into January. So that's a good thing for those folks. It's a good thing for the U.S. economy. Let's break it down and see what it really means here. We can do that with Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us from Princeton. So, Lee, what did the shippers and the dock workers, what did they actually agree to last night?
Well, they agreed to go back to work and go back to the negotiating tables. So, they're going to go back to work until an agreement is made. The new deadline now is mid-January. So, that's obviously on our radar, much like how this last deadline of September 30th was on our radar. And so what that means is that they're going back to work. It's going to take some time to clean up the mess at the ports because there was a backup. Roughly speaking, it takes about a week to clear congestion created by one day of a strike. So call it 3 to 4 weeks until things, quote unquote, get back to normal. And my guess is that the unions, when they do go back to work, they're not going to be going at full throttle. They might be kind of dragging their feet, if you will. So the supply chains are getting back to normal, and hopefully the two sides can come to an agreement where, truly the efficiencies and the throughput is returned to where it should be.
What do we know so far about why the workers actually decided to end the strike?
The why, that's a great question. I'm not, in those meetings, but my guess is that both sides are being pressured significantly by the Biden administration. The Biden administration said that they did not want to enact the Taft-Hartley Act, which pretty much tells the two parties that they got to go back to the negotiating table and cool off for 80 days. They didn't want to do that because obviously the Biden administration wants to be considered a pro-union president. And then on the other side, Biden administration also doesn't want to see anything to hurt this fragile economy that we're currently in. Growth is expected 1% to 2%, some tepid growth, but it's growth nonetheless. And obviously a prolonged strike could impact those growth numbers. But I don't think it's going to have much of an impact on overall GDP, maybe delaying some things. And on freight rates, you're seeing some of the marine shipping names like Maersk. They're down mid-single digits in trading. And that's really being driven by the fact that if there was a prolonged strike, rates would have probably been bouncing higher. And what we see now is that maybe they're not going to get that bounce. They're still a lot higher than they were last year, but they're still not going to get that extra boost created by the congestion and issues from a labor strike on the East and Gulf Coast ports.
Lee, it sounds like, there's a couple issues there between the two parties. One is just wages, and presumably that is something that you can bridge the gap and get something done. The other one is productivity and modernization and bringing technology here that would threaten jobs. That seems to be a lot harder to deal with. Any sense of how far away they are or how close they may be?
On the money side, from the last numbers that we saw, the union has been very vocal, wanting 77% increase over 6 years, which is roughly a little under 10% a year. And then, the ports came back at around, they upped it from 40% to 50%. I'm assuming they're going to get closer to that 77% over time. The automation is probably a lot more sticky. The ports do want to have more automation. And automation isn't necessarily, a robot comes in and takes out a job. It just might be a different job. And there are ports where, workers are not necessarily, there's one in New York, one of the ports within the port system in New York and New Jersey, where they have some automation where there's people kind of operating joysticks, if you will, in an office, and they kind of take control the last couple minutes or the first couple minutes of moving something to ensure its safety. It's not only a productivity standpoint, but also obviously the less people you have on the port, the safer it is. Accidents do happen. And so, I don't know where they're going to come out on this, but obviously the ports want to be more efficient and the union wants to save jobs. And they just need to figure out, some sort of middle ground, because at the end of the day, there's great technologies out there, whether it's, letting trucks in and out of the port a lot quicker. And that's not only good for port throughput, but it's also good for, if you want to take an environmental standpoint, you don't have a queue of trucks a mile long waiting to get into the
Port Authority of New York. All right, I got you. Lee, great stuff as always. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst with Bloomberg Intelligence, giving us the latest. U.S. stock workers go back to work as talks extended to January. That is good news. Coming up, we're going to have more discussion on this market. This is Bloomberg.
There's a lot of research on this. There's really been three. Number one, prosperity, as you've said. Number two, improvements in healthcare. So in 1900, half the children died on the planet before their fifth. And the third was the education of women. So we've had some pretty interesting questions put up here, but let's try this one. What keeps you up at night and what gives you joy?
Well, I think kids give me joy. So I probably get the most joy from my kids. I'm not saying that that's the reason to have kids, because we should have them anyway, but I certainly, kids are the greatest source of joy in my life. In terms of what keeps me up at night, I guess it's anything that's like, I think, a civilizational risk. If we're, birth rates continuing to plummet, I do think about the birth rates plummeting as being a civilizational risk. I think anything that undermines the foundations of democracy in America or elsewhere as a risk. I think anything that's leading us away from a merit-based system is a risk. I actually spend I listen to like podcasts about the fall of civilizations to go to sleep. So perhaps that might be part of the problem here. There's literally a podcast called Fall of Civilizations, which I've listened to a few times. I'd also recommend Hardcore History if you haven't listened to that. It's a great podcast. I listen to history podcasts basically to go to sleep. So that's probably why I'm ruminating on these things as I go to sleep.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Seeing a bit of shift in the markets. Right now, they're mixed, and this is after U.S. jobs growth last month topped all estimates. The unemployment rate unexpectedly declined. Wage growth, that increased. So let's take a look. We had the NASDAQ up 0.4%, up 75 points, 17,993. The Dow, little change, but down 12 points, 41,998. And we have the S&P 500 up 0.1% at 5,708. We have the two-year yield, 3.86%. That's up 16 basis points. The yield on the 10-year 3.95%, and that's up 10 basis points. The commodities, we have spot gold lower, $2,651 an ounce. Brent crude up about 0.5%, $78 a barrel. WTI crude, $74 a barrel. Looking at currencies, the dollar stronger. Japanese yen down 1% at 148.49 against the dollar. We have the euro, British pound weaker. Bitcoin up nearly 0.5% at around 61,000. Shares of Rivian down this morning about 6%. The company cut its production guidance for the full year. And then we'll stick with EVs. We'll go to Alphabet's Waymo, expanding its robo-taxi fleet with electric vehicles from Hyundai, and they will be built in the U.S. And meanwhile, sources saying Hyundai is seeking a valuation of $19 billion for an IPO of its India unit. That could be the nation's biggest share sale. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Emily.
Hi, Lisa. Thank you so much. We appreciate that. Emily Grafeo sitting in for Alex Steele here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. ARK Investments CEO Kathy Wood, she joins Bloomberg Business Week today right after the closing bell to talk artificial intelligence and her latest investments into OpenAI. Catch the conversation with Carol Masser and Tim Stenovic at 4 p.m. Wall Street time on Bloomberg Radio and television. So that will be some good stuff here. A wicked good print, as they say, up in Boston. Two-year yields up 16 basis points. How about that? I'm going to talk to a yield geek. That's Ira Jersey. He is the best in the business. Chief U.S. interest rate strategist for Bloomberg Intelligence. Ira, with much trepidation, I do look at the WERP function every now and again, but I feel like it's so misleading for novices like me. But I guess we're taking that 50 basis point cut maybe off the table. Is that the way to interpret today's data?
Yeah, absolutely. The market has just completely gone away from the idea that we need an emergency, oversized cut. Almost any time actually over the next 3 months. So the market now is saying, okay, the Fed's probably going to cut. It's going to be at 25s. And there is the risk too, and this is something that you have to look longer term also. And the reason why 10-year yields are up 10 basis points today is really that we're pricing for a higher terminal rate. So the market's not expecting the Fed to cut quite as much as it was yesterday after this, definitely stronger than expected jobs report.
When you look at the market action today, is this investors kind of cheering the Fed's move, I guess kind of praising the fact that the Fed made the right decision to go 50 initially?
Well, I actually think that the market's questioning whether or not the Fed needed to go 50, right? When you have job market creating 200,000+ jobs, you have wages growing at a pretty decent clip, right? Almost 5% on a year-on-year basis. The market's questioning, and we've certainly had some investors saying to us, it's like, look, maybe the Fed has to stop. It might, we think that they might cut maybe 2 more times and then stop. That is completely possible if you continue to have data that shows that not only do we have a decent economy, but maybe it's re-accelerating. And that's one of the reasons why I think the next couple of data prints are going to be critical for what the Fed communicates at its November meeting. Because even though it's probably going to cut, and cut 25 basis points now, not 50, almost regardless of what the next couple of data prints show, they might communicate that, hey, maybe we're going to be not as aggressive as the dot showed, and maybe we're not going to be as aggressive as the market was thinking prior, after our September 50 basis point cut. So I think that the market has to reassess all of that with the incoming data. And the Fed's done this to themselves, because tying themselves to the incoming data means that when you get a print like this, you have to expect them to react to it in some way, and that way is slower cuts or less cuts overall.
Ira, asking for Lisa, who writes in, where's the best value in the Treasury curve these days?
Well, it's still probably the front end for two reasons. One is, the yields are basically the same across the board, right? Yes, the yield curve is upward sloping now, but it's only a couple of basis points, right? It's a handful, a dozen basis points depending on where you're looking at on the curve. And second, that's where you take the least amount of risk on a mark-to-market basis. So depending on who you are, right? Depending on if you're a total return investor who cares about, what is your return going to be over the next 3 to 6 months, if you buy the 2-year yield, the 2-year yield has to double in order for you to start losing money. Whereas the 10-year yield, if it goes up another 20 or 25 basis points, you start losing money over the next 6 months on a total return basis. So I think the front end probably has a better risk reward.
I'm looking at wage growth, which also grew.
Yeah, so am I.
Faster than expected. And I'm wondering, Ira, if you think traders need to start worrying about the risk of inflation, or even the Fed needs to be thinking about, that risk that they said they're not so worried about anymore.
Yeah, I think it is, right? Because the consumer, even if the job creation is, 150,000 like it was expected to be for September, but you had this kind of wage growth, we'd still be questioning whether or not the economy was actually slowing, right? Because the consumer and the services sector in particular has really been driving this. And if you look at the internals of the data, we created over 200,000 service jobs in September, and that type of reacceleration of that job market really is I think a sign that the economy is not slowing very very quickly, and given that the goods sector has been kind of tepid over the last 2 years. Services is really what's driving everything. So as long as you have wages growing at a reasonable clip, you still have consumer spending, and that means that it'll be hard. I don't know if inflation will necessarily go up a lot, but inflation won't be coming down any further. And because of that, you still haven't quite reached the Fed's target. We're close, right? And over time, we'll wind up seeing a 2.3% year-on-year PCE print. But but we're still not probably going to get to 2% anytime soon if wages continue to grow at 4.5% to 5% on a year-on-year basis. That means you have plenty of money for consumers to continue to spend as long as they keep on getting wage increases.
All right on cue for Ira. Red headline crossing the Bloomberg terminal: traders price in less than quarter-point Fed cut in November. So the jobs report today certainly have an impact on the market. Hey, Ira, again, that Lisa from the 5th floor writing in again. What is the Fed doing with the balance sheet? Are they buying bonds, selling stuff? What are they doing these days?
Yeah, they're continuing to run off their balance sheet. We think that they'll continue to do that into early next year. But we're getting to the point where reserve balances are getting quite close to no longer being abundant and instead being ample. And you saw that earlier this week when the standing repo facility, the SRF, when that got tapped for a very small amount, only $2.6 billion. But the fact that it got tapped at all is a signal that at least some institutions need to get more reserves. And then you saw reserve balances as of Wednesday night, which came out late yesterday, are now at the lowest level they've been in over a year, and just a little over $3 trillion. It sounds like a big number, but there's a lot of structural reasons why banks need to hold reserves to comply with Basel capital regulations and some other Fed rules. That means that once we get below $3 trillion, we think that funding markets, so repurchase agreement markets and Fed funds and T-bills and the like, will get a little bit dysfunctional, and that's when the Fed has to stop lowering the size of its balance sheet.
All right, Ira, great stuff. As always, Ira Jersey. He is our chief U.S. interest rate strategist for Bloomberg Intelligence. He's down in our Princeton, New Jersey office for Bloomberg Intelligence. And again, looking at the yield curve, the 2-year Treasury is up about 17 basis points, 3.87 for your two-year. The 10-year is up about 10 basis points here, 3.95. So we're definitely on a 4% watch for that 10-year, and we'll see how long this plays out here. WTI crude oil, it's up 0.8%. We're about $74 a barrel. We're going to check in with Mike McGlone. He covers all the commodity stuff for Bloomberg Intelligence. Get his thoughts on the movement in oil. It's been the biggest gain in the week for a long time. That's coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Emily Graffeo in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Live Radio, and that's where you'll find us. We've been looking at oil. Oil is set for the biggest weekly gain in 2 years on this escalated Middle East risk. We're looking at Brent crude right here, $78 a barrel. So we are on that $80 watch here, up about 59 cents per barrel today. Mike McGlone joins us, senior commodity strategist for Bloomberg Intelligence. Mike, I know you've had a kind of a bearish call on oil for a long time, and it was trending down there. We had Brent, just about under 70 there before we saw the Mideast kind of erupt there over the last week or so. How do you view the energy markets these days, short term and long term?
Bear markets are notable for the sharpest rallies. Big picture, it's still very much of a bear market. Certainly, if you look at it since 2008, Brent is making has been making lower highs and lower lows, and we made a lower high just a few years ago. We're just hovering at the $80 a barrel level. I think that's a key kind of pivot resistance level. But the key thing that really reason it's bounced is managed money net positions, i.e. futures traders, one of what I used to be, were completely sold out. So this is kind of normal, expected. It got the catalyst to go higher with increasing tensions. But the bottom line is it going to substantially reduce supply on a global scale and or increase demand? And it's very unlikely, particularly if there's any kind of attack. It's much more likely all that excess spare capacity out of OPEC, certainly from Saudi, will come on the market. They have a reason to. So to me, this is a bear market bounce. I think if Brent can sustain above 80 for a while, that would maybe negate that. But overall, I still think it's more likely to head towards 60 by the end of the year. One key indicator is you're seeing declining imports from China. We've seen declining interest rates. Yet, okay, of course, they've stimulated, and of course, excess of spare capacity and supply out of OPEC in the U.S. are signs that OPEC, crude oil is just an oversupplied bear market.
So then you're saying that any strike by Israel on Iran's oil, Citi estimated that could take 1.5 million barrels of daily supply off the market. Traders shouldn't be concerned, I guess, about that risk that supply would come off.
Oh, sure. Well, first of all, that's an if statement. Mm-hmm. It could happen. They export about 1.7 million barrels a day. And where are all those exports going? To China. So it'd be a problem for China. And what's happening with demand in China? It's declining. So it's just the key thing we have to be careful about. Those are the wings of the kurtosis of the bell curve. What's more likely to happen? Sure, you have to hit that infrastructure. You have to reduce that supply and keep it off the market for a long time. What's more likely to happen is the bigger picture macros continue. And so those things markets always look ahead. They're pricing in for that potential risk, which is probably the risk. So I look at $80 WTI Brent. $80 Brent. Traders more likely to be looking at as responsive sellers and willing to get stopped out if there is a major attack. But I just, having been through when we had the Saddam Hussein invade Kuwait and all these things that happened, the minute that missiles start flying or wars start kicking in, oftentimes if prices already spiked, that's when they collapse. The point is we've already jumped a lot for this. And you pointed out it's been a pretty substantial rally off the lows.
So, Mike, what do you think the market's discounting these days about underlying supply and demand for oil, I guess maybe in the next 6 to 12 months?
Growing excesses. It's becoming a bit of a consensus, which concerns me a little bit. I always like to be against consensus in commodities. That's usually how you make money, but it's becoming overwhelming. The bottom line is basically China imports about 11 million barrels a day. That's the same as 2020. That hasn't happened in 30 years, that they've stagnated their demand. And we know what's happening. They're doing massive stimulus because they have to. Key indicator I like to watch out of China is their bond yields. The 10-year note yield at 2.21. $2.21% is very low and declining. So then you look at the thing that's really been driving the lower prices for the last almost 15 years, and that's the excess of supply and demand out of Canada. Right now, liquid fuels and crude oil, it's about 6 million barrels a day. That's about the same as what OPEC is in spare capacity. Put that in context, in 2008, that was a $10 million deficit. And just in 2009, before COVID, it was only a surplus of 2 million. Now it's 6 million. You see the trends there? And then I'll end with this. You just saw today that that Europe had to put 45% tariffs on Chinese EVs. Well, in May, the U.S. put 100% tariffs on Chinese EVs. The shift in technology replacing petroleum is overwhelming. In the meantime, we have declining demand from the world's largest demand source, and that is China.
All right, Mike, thanks so much for joining us. Always appreciate getting your calls because they are concise and they are clear. Mike McGlone with a lot of conviction as well. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. He's been, bearish on oil. He's been saying WTI crude oil is going to see 40 before it's going to see 100. And that's kind of where we were trading. We were at WTI crude oil was, well into the 60s, looking at low 60s. And then we've had this significant move higher this week.
He also writes that Brent crude $80 ceiling may be the new $100 ceiling. So maybe a little bit more bearish than the rest of the consensus calls.
Yeah, I mean, I guess what what you're learning with talking the Mike McGlones of the world, the commodity folks, I mean, you really have to have a strong call on supply and a strong call on demand. And a lot of these oil traders will have these very extensive demand models trying to get a sense of where the demand could come from. And right now, when you think about it, it's China has kind of always been that X factor over the last 20 or 30 years as a marginal buyer of oil. Now with a slowing economy, you can't make that assumption anymore. And that's kind of, I think, been one of the fundamental underpinnings of Mike McGlone's more bearish take on oil going forward. So, but again, moving higher here on the back of the heightened tensions in the Mideast over the last week or so. We'll stay on top of that. S&P, we're looking at it's up about 19 points here, holding on there. The Dow's up about 67 points. The Nasdaq's getting a little bit more of a lift, up about 117 points. That's 0.6%. The Russell, the small capper's leading the way today, up about 1.1% at 2,200 on the Russell 2000 index here. So we keep an eye on that. And for Matt Miller, I know he's listening, up about 0.7% is Bitcoin. 61,200 for the cryptocurrency. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up a strong hour ahead, we're going to talk about that labor market with Tom Gimbel. He's the founder and board member at LaSalle Networks. LaSalle Networks is one of the biggest placement firms in the country. They know what's happening in the job market, so we'll get the latest from him. It is Friday. That means we talk municipal bonds, and why not Eric Kazatsky from Bloomberg Intelligence? He does all that muni stuff. He's going to join us as well. Brian Levitt, global market strategist, Invesco. They manage a lot of money there at Invesco. I wonder if this jobs print today changes their outlook at all for the market. So we're going to break it all down coming up in the next hour. But first, let's start it off with the Charlie Pellet.
And a strong hour indeed, Paul Sweeney. We have got the Dow, the S&P, NASDAQ, all pushing higher right now. Stocks did pair earlier gains on this Jobs Friday on concerns that a stronger than expected jobs report signals that inflation may be more entrenched than expected. But here's where we stand. The S&P right now up 22 points. That is a gain of 0.4%. The S&P back at 57.23. Dow Industrials up at 42,101, up 90 right now. A gain of 0.2%. NASDAQ pushing higher by 0.8%, up 138 points now. Russell 2000, the outperformer, up 1.2%. Small cap shares rallying after this morning's jobs report. We've got the 10-year at 3.95% right now. 3.95. That bears repeating. 10-year 3.88%. Spot gold up $3 the ounce, up 0.1%, 26.59. And West Texas Intermediate crude above 74 now, continuing its advance this week, up by 1%. Bottom line here, traders are pricing in less than a quarter point worth of interest rate easing at the Fed's November gathering. Reaction to this morning's jobs report from acting U.S. Labor Secretary Julie Su.
Many people predicted that we would not be able to do this, have this kind of recovery, and have incredible job growth while keeping the unemployment rate low, while bringing down inflation and interest rates. All of those things are now happening.
Acting U.S. Labor Secretary Julie Su. We are keeping an eye on shares of Rivian Automotive today. They are down now by 6%. Shares tumbling after the automaker cut its annual production target, citing a worsening supply crunch at its lone U.S. assembly plant. Our Nora Melinda will have a whole lot more on Rivian and other stocks coming up in just a moment. ARK Investment CEO Kathy Wood joins Bloomberg Business Week today right after the closing bell to talk AI and her latest investments into OpenAI. Catch the conversation with Carol Massar and Tim Stenovic at 4 p.m. Wall Street time on Bloomberg Radio and Television. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate this. Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, Charlie, this is not good. As you know, I've got my business degree at Duke. I'm surrounded on both sides by UVA. This is not good. Emily Graffeo, Norma Linda, both graduates. See, I did not get into undergrad UVA. So what I did to get my revenge is I applied to the business school and to the law school, got into both, rejected both of them.
See,
how about that?
and that's what you have to do.
I felt great about
He said
that.
some payback there.
Exactly. Right. So anyway, and I had no intention of going to law school, but I just applied just so I could do that. So that was good fun. Love my friends down in Charlottesville.
Wahoo
all right,
wah.
wahoo wah. Absolutely love it down there. Norma Linda joins us. She covers all the equity markets for Bloomberg News. Nora, what are you looking at today?
Well, I'm keeping an eye on quite a few things. Of course, we do have the broader market up higher after that jobs report that we did get this morning. But I'm watching Spirit Airlines. And of course, we know this has really been an embattled company recently. But we're seeing shares sinking as efforts to restructure the company's debt and avoid a filing for bankruptcy have apparently hit a snag. And this is after months of talks with bondholders. And this has really failed to result in a deal. But what I am seeing is some of its peers, we're seeing a lot of airline stocks higher, and they're all benefiting off of the idea that they can actually take on some of the market share and some of the markets that Spirit was really paying attention to. If you think about JetBlue, that's one of the other budget airlines that people view to be their competitor. They are really focused in Florida and some of the other markets that Spirit currently occupies. So we are seeing other companies rallying off of this news.
Well, I'm a Newark airport person, so that means I'm a captive to United. Have either of you flown Spirit?
I don't think so. I have.
And?
I think I flew it to the Bahamas back in 2019. This is back in college. Super, super cheap at the time, or so I thought it was, until you add your luggage, your bags, and all the odds and ends. You realize you should have just flown Delta.
Paul, there's a meme that is going around the internet.
Yes.
That it's like whenever you take a Spirit flight, then the flight attendants come around and tell you when it's your turn to fly the plane. This is completely a joke. I don't think this has ever actually happened, but that is certainly the discourse around this airline on social
All right,
media.
so without a deal, apparently looking at the Bloomberg reporting, without a deal, the company would be forced into bankruptcy, said the people. While a Chapter 11 filing isn't imminent, a near-term filing would pose challenges, as would be unclear who would take control. So, all right, we'll keep an eye on Spirit Airlines. What else you got?
Also keeping an eye on real estate, as always. This is the worst performing sector today. And of course, we are seeing the majority of the market rallying right now. But real estate, and then also followed by utilities, they are falling after rising bond yields are really denting sentiment. I'm looking at real estate in particular. We're seeing the sector declining, mostly led by specialized REITs. I did see that office REITs and hotel REITs are actually up, but specialized REITs are falling today.
Got that REITs in there.
Of course.
Of course. Always. Anything else here?
Yeah, I mean, of course, we can't stop watching Rivian. I mean, this company has really been in focus today, especially after it cut its production guidance for the full year. It's pointing to a supply crunch that, of course, we know it's really been battling for quite a while. I mean, the CEO last month said that the company was contending with, quote, a couple of challenging supplier issues, and specifically referred to EV motors that Rivian makes internally. But we do know that EVs have really been struggling to gain traction with people not really wanting to purchase. I mean, do you guys have an interest at all?
None.
See?
But I'm not the demo.
Yeah,
you guys are the demo.
Are we really?
Well, you're young.
New York City residents the demo?
Well, I was thinking more age demo.
I would be interested in an EV, but probably not a Rivian, right?
Okay.
That's a good point. That's a good point. It's funny, I was walking just past their shop that they had a couple weekends back, and I've never really have spent much time really looking at those cars in particular, so Rivian's never really been on my radar, to be honest.
All right.
I think Amazon delivery trucks when I think Rivian.
That's probably not what they want.
I don't want to be
stock
driving
down
around in that.
6% today, down 56% year to date. So tough business there. And I just think that there's just when I talk to smart people about the auto business like Matt Miller or Barry Ritholtz, there's just a real fundamental question about what the real ultimate demand is for electric vehicles in this country. And I know it's a combination of price and, charging capabilities, and there's a lot of variables that go into that demand equation. But I think that the early adopters have adopted.
Right.
And now you got to get everybody else. And I think price is big, reliability is big, resale value is big, the charging, all the things we think about when we buy a regular car, I guess. So anyway, I just got some new wheels about a year ago, and I got the old gas engine, so I'm good, thank you.
You're good.
And I got $2.85 a gallon last weekend at the Jersey Shore, so that was
I'm
big.
jealous. As if I even have a car here in New York, but I'm still jealous.
Exactly.
That's the New Jersey pricing.
Exactly.
Yes.
Norma Linda, thank you so much. We appreciated the pride of University of Virginia, class of 20...
19 what? Where were you going?
Yeah, I was going to say 1986 for me, undergrad.
I'll take it.
2021, just please give me a break.
Exposing me.
I got socks older. All right, very good, Nora. Thank you so much for that reporting. We appreciate it. Again, the story of the day, one of the economic stories of the day is certainly that jobs number, and it came in really strong, the non-farm payroll here. So let's break it down with somebody who does this stuff for a living, Tom Gimbel. He's a founder and board member of LaSalle Network. LaSalle was founded in 1998, and it is one of the leading staffing and recruiting firms in the country. So this is Tom's business. Hey, Tom, you guys put up, being the labor markets, a pretty strong data point here today. What do you make of it?
Well, I think number one, I went to the UVA of the Rockies, University of Colorado.
There you
go.
If
we can get a Go Buffs real quick. But,
you bet, Go Buffs, Go Buffs.
There we go. Listen, this report is, if you're anything but optimistic after this report, you're crazy. This is an unbelievable number with unemployment dropping and higher than expected jobs numbers, and it's a really good sign for the economy.
So what do you make, Tom? Where is some of this demand coming from? There are a lot of people that want to maybe poke a little bit of throw some shade on this and say it's coming from leisure, it's coming from healthcare, and not really the higher paying jobs. How do you when you go underneath the surface, what's it look like?
Yeah, I think I always find that interesting, right? So they would rather not have people being hired in hospitality and leisure and construction. Like it's the fact that we have consumer spending that happens at hotels and restaurants and service industries means that consumers are making more money and they have more disposable income, which is a positive sign for the economy. So that hiring is really good. And what'll end up happening is that continues to fuel it, that if people are spending more, than the companies that make those retail products will be hiring more people at those companies, and so on and so forth. And without getting too Reagan-esque, but it's trickle-down economics, and you're going to have a situation where it keeps fueling better employment numbers, which is exactly what we want to have happen. Now, the one soft spot I continue to see is in recent college grads. I'm not seeing the volume of hiring at people coming right out of college a year out as I have during other bull markets, but I think that'll change post the election.
From your neck of the woods, how much are people actually talking about the Federal Reserve and the impact of rate cuts on the labor market? Because obviously at Bloomberg, we are just obsessed with every, piece of data that comes out and what it means for the Fed. But, how much do you actually talk about it at LaSalle Network?
Oh, I think that whether it's LaSalle Network or the CEOs and CFOs and heads of HR that I talk to on a regular basis, the Fed rate is really important to people. And I would say more on mid and large cap companies, because they're looking at the cash flow, the borrowing rate, how they're going to be able to hire people, how their wages affect their bottom line. And so I think it's a really important indicator that people look, even if people don't understand exactly what the Fed rate means, they do get that when rates were really low, there was nothing stopping hiring in the economy and what's going on. So when companies see that the Fed's dropping rates by 50 basis points, people get excited. Now, the biggest difference, and I've been preaching this with you guys and elsewhere for a long time, is that we have more employers in this country now than ever before. And what I mean by that is, if you would have gone back 60, 70 years ago, if somebody lost their job at Ford or General Motors, they were car people. They could only get jobs if the car industry, rebounded. today, skills are so transferable due to technology, and while I think it's not going to last forever, but remote work, that you can lose your job in Detroit and be working for a company in Silicon Valley as well. And so we have that opportunity. And then the startup nature that companies and individuals can raise venture money and startups, that I don't think we're ever going to have an employment lag like we had in the 70s really ever again.
Tom, I guess I haven't asked you this in a while, but where are we on that whole remote work? Have we settled into a new normal? And I guess that's company by company, 3 days, 4 days, 5 days. Where do you think it is these days?
Yeah, I think right now it's 3 days. I still see, it still amazes me, Paul, how many CEOs are afraid. They'll talk to me, they'll talk to each other, and they'll say, God, we got to get people in, but they won't lead. They won't say it. And that to me is really the disturbing part. I think the Amazon statement last week was really powerful, and you'll start to see some follow the leader type statements coming out. I think where we're going to get to is 4 days a week, and some companies going 5 and some going 3, but the average will be 4. And come 2025, we're not going to remote work and people wanting that isn't going to happen. And you're going to see when companies start to downsize, and that will happen. And other companies will hire them, so it won't affect the numbers. But when you see companies lay people off, it's going to be the remote workers that get hit first.
Just going back to the print that we saw this morning, hourly earnings rose 4% from a year ago, the biggest advance in 4 months. I'm wondering what you make of this upside surprise in wages and, you know, what that tells you about the strength of the labor market.
Well, I think it's interesting, and I have to dive a little bit deeper into the hourly wage increase, and I saw that as well. But it really comes down to you have more people working more hours, and in the retail space, it's so hard. I mean, listen, I'm in Chicago. I was in New York a few weeks ago. I was in Nashville last week. It's really, when you go to a restaurant, the service is lacking because there aren't enough people. And I talk to the managers when I'm there to find out on the ground what's happening. And I think what you're seeing when you see hourly rates increase, hourly wages increasing, it's because you can't find the people. And so you got to pay a little bit more to make sure that your people stay. And if you find somebody, that you're getting the best that you can get.
Tom, you mentioned just about college graduates still having a tough time. Why do you think that is?
I think because usually what happens with kids out of college, and I'm not talking about accounting degrees or pre-law or whatever, but more liberal arts education, the massive state colleges and people coming out, is that companies hire in volume, whether it's sales or marketing, or they're going to do a training class and all of that type of thing. And when you hear the skies falling every day from both sides of the political spectrum during an election year, companies put the brakes on massive hiring at individual companies. So we're seeing sporadic hiring and small, medium-sized business hiring, but we haven't seen the huge uptake of late-stage venture companies, private equity companies that are really pouring money into hiring in mass. And that's the biggest difference I see versus 2001 and 2018, 2019, when the market was really on fire.
We only have about a minute left, but what's the outlook here for job growth for the rest of the year, particularly when you take into consideration the hurricanes in the southern United States?
Yeah, well, I think that's an interesting one, and I'm sure you'll have a lot of people talking about it. My take on it is you're actually going to see a lot of additional employment in the Southeast because we need people to do the work to clean it up. And the companies that do that, whether it's the government or private industry, don't have enough bodies. So you're going to see a lot of hiring going on down there. And the companies that employ the people who can't get to work, those people aren't going to be fired, most likely, and not filing unemployment. So I think we'll actually maybe see a spike in the October jobs report coming out that first Friday in November due to the hurricane, that we'll have a mass of people going to work in the Southeast to help that situation.
All right, Tom, thanks so much for joining us. As always, love talking to you on Jobs Day. Tom Gimbel, he's a founder and board member of LaSalle Network, giving us a breakdown there. Obviously, he's taking a very positive take on those strong jobs numbers. And again, I'm glad you pointed out, Emily, the wage number, because that's been strong, and it's been higher than inflation for the last almost 2 years now. So the real income for most Americans after the very difficult time coming during the pandemic has actually been quite positive real income. So that's vis-a-vis inflation.
Yeah.
Purchasing power there. So that is good news. S&P 500, it's up about 0.3%. That's 19 points. The NASDAQ's up about 0.6%. That's 112 points. And again, we're calling out the Russell here today because that's been the strength, up at 1.2% on the Russell. Yields higher. 10-year Treasury yield up about 10 basis points, 3.94%. So we are on 4% watch there. WTI crude oil up about 1.3%. That's just under $75 a barrel. And we were down in the low 60s just about a week ago here. So the rising tensions in the Mideast certainly being impacted, or certainly impacting the global energy market. So we will stay on top of that. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg Jobs Friday. We got you covered. This update brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. We have got the Dow, the S&P, and NASDAQ all advancing. Let's toss in the Russell 2000. That index of small cap shares up now by 1%. To put that all in context, S&P up 0.2%. The S&P right now up by 13 points. The Dow is gaining 12, a little change there. NASDAQ up 95, an advance of 0.5%. 10-year 3.94% with a 2-year at 3.88%. Gold up $6 the ounce, higher by 0.2%. And we've got West Texas Intermediate crude with a 74 handle, 74.59, gaining another 1.2%. So it is Jobs Friday, and we had a stronger than expected number this morning, signaling that inflation may be more entrenched than expected. Reaction to this morning's number from Tom Gimbel, the CEO of LaSalle Network, a job placement firm who was interviewed moments ago right here on Bloomberg Intelligence.
This report is, if you're anything but optimistic after this report, you're crazy. This is an unbelievable number with unemployment dropping and higher than expected jobs numbers, and it's a really good sign for the economy.
Tom Gimbel of LaSalle Network. Sources tell Bloomberg Spirit Airlines' efforts to restructure its debt and avoid filing for bankruptcy have hit a snag after months of talks with bondholders failed to result in a deal. We've got shares of Spirit, which uses the ticker symbol SAVE, down now by 27%. Spirit, as you well know, has been seeking a financial lifeline ever since a federal judge in January blocked its proposed sale to rival JetBlue Airways. JetBlue shares, they're surging today. We've got JetBlue up by 16%. Recapping stocks higher. Should mention the Dow just turning negative, now down 15. Little change there. S&P holding on to a gain of just about 0.1%. And coming up after the close of trading today, ARK Investment CEO Kathy Wood will join Bloomberg Business Week to talk about her latest investments into OpenAI. Catch the conversation with Carol Masser and Tim Stenovic at 4 p.m. Wall Street time on Bloomberg Radio and Television. And that is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds. There you go. That's how we roll here. Eric Kozaski joins us, Bloomberg Intelligence Senior Municipal Strategist. Eric, I'm going to let you do a little bit of a victory lap here. You Muni guys had a heck of a September. Tell us about it.
Huge September, best returns in over a decade. You know, it really speaks to the demand for tax-exempt income and just the overall interest in our space. You know, I think, and we said this before on our previous conversations, the closer we get to this election and we find out more what the tax situation is going to be, the more municipals are really going to become a national topic as far as being a part of portfolios that really aren't being thought of right now.
So this municipal, I've always been a fan of munis. What's changed
well,
in a month?
I know you have, yeah.
I mean, what's changed in a month? What's really, I mean, I guess is it kind of getting closer to the election, but if anything in the structure of the market or the fact that the Fed has in fact started on a rate cutting move?
Well, I really think it's a fact that a lot of the rate move that the Fed actually, you know, came out and cut to 50 and whatever preceded before it was being priced into the market, and especially being priced into the market on the muni side of the things, right? So what you had was an overall interest in locking in some longer term yields in the muni market. And so that really drove the demand side, and you had a lot of cash coming back to investors. So you really had sort of that fear of higher taxes coming in and being pulled forward into September, and it really benefited performance.
New issuance, how's that looking? Because I know in the corporate bond market, September was just a record. How about in the muni space?
You know what, really keeping a heady pace. We're in that 35 to 40% year over year, although I think it's going to sort of moderate here, right? Okay. Rates are creeping back up, although munis really aren't as reactive as treasuries today. So, you know, a lot of that was anticipating, you know, the Fed being a lot more active and a lot of refundings coming back into the market. So if rates sort of stay elevated here and inflation is entrenched, as you guys just mentioned, you know, that could be a problem for new issue sales going forward.
I'm an ETF reporter, and when I think munis, I think about the flood of new muni bond ETFs that are coming onto this market, particularly in the high yield space. What are we supposed to make of that, Eric? What is that kind of signaling about the current muni bond market?
I think it's a good thing. It shows that there's a willingness and ability of a lot of these product managers to sort of rethink the old ways of doing things, which were mutual funds, and to sort of, appeal to a younger cohort, let's say, right? Because a lot of what we're seeing being pitched in our space and coming to the market are really active ETFs, which are just ETF wrappers around a mutual fund. And it's being done on the high yield side. And performance has been really strong. So it really gives them a strong story to go out because you have increased liquidity, most of the times cheaper fees, and better performance right now. So really sort of a trifecta to hit on people with.
Another big news item over the past week has been Hurricane Helene, and we've been talking to Matthew Palazzola. He's the insurance analyst for Bloomberg Intelligence about the insured and uninsured losses out there. How about in the municipal bond market, Eric? Is there any risk to any of those issuers in some of those hard-hit areas?
Risk is a very subjective term when it comes to our market, and I will qualify by saying there really is no history of a rated bond default due to a natural disaster in the municipal space, right? And really, that's sort of the line we have when we talk to clients. But this is really sort of a unique event in the fact that this storm touched about 91 different counties, and so we put together a pretty large database of sort of all the municipal bonds that were tangentially affected, and we've calculated about 31 billion. I think the problem is, especially in the areas that were the hardest hit with floodwater, is that really flood insurance was non-existent. And in Buncombe County, you really had like 1% of the homes that actually had flood insurance. So the problem is really going to be getting that tax base back to where it was pre-Helene.
Any credit risks out there that you guys, or any issuers in particular, that are getting the attention of your market?
It's always Chicago. It's always Chicago public schools, which are grabbing national attention. You know what? But the market is arms wide open, and they're happy to keep financing them at, market rates that are, what I would say very tight spreads. But until and unless there's a market penalty, issuers are going to keep coming to the muni market and find very well reception.
One thing I've noticed about the new issue market, and I pay attention to that probably the most closely in the muni space, is there's been some billion-dollar deals. I mean, some big size deals, and I don't usually see that. So, A, is that unusual this year? And B, if it is, why?
You know what? I think it had to do with a lot of that tax fear coming forward, a lot of activity with bankers, sort of getting ahead of that. But the market's reception, the market has grown, it's matured, right? You have a lot of those ETF products, a lot of those fund products, which are looking to do deals in size and which are willing and able to sort of fund a lot of those off the run infrastructure projects, which happen to be larger. But it's not only the larger deals that are interesting in our market, there's smaller deals that are pretty interesting as well. One of the things that's coming up on the calendar is a small stadium deal, about $70–80 million for the Chattanooga Lookouts, right? So what's interesting is just the bond coverage on something like that is like 30 to 40 times the debt service. So it's interesting, just like when sort of you dig in the weeds in the muni market, that's where really the beauty lies.
Tennessee Lookouts. Lookout Mountain, Tennessee. Roscoe Tanner, tennis player back when I was a kid. It sticks with me for some reason. I have no idea why. Eric Kozarsky, thanks so much for joining us. Bloomberg Intelligence, senior municipal strategist. The best month in performance in over a decade for the muni. So how about those folks taking a victory lap? All right, let's talk about electric vehicles. And when you talk about electric vehicles, I feel like you got to talk about tariffs, because it seems like everybody's slapping tariffs on everybody else's EVs, particularly the ones coming out of China. The EU, the latest, the EU announces that they are imposing tariffs of up to 45% on Chinese electric vehicles. How big of a deal is this for that market? David Welch joins us, Bloomberg Detroit bureau chief. So if I'm a Chinese EV, I mean, am I welcome anywhere on this planet outside of China? What's going on there, David?
So far, they've had growth in Brazil, not just EVs, but Chinese car makers in general, and the Brazilian government hasn't hit them yet. But, look, the Chinese benefited greatly from American, Japanese, Korean, European companies going to their market, and we split the profits with them. We gave them our technology, and, now a lot is happening that's squeezing out all those foreign interlopers. And they have tons of excess capacity in China. I mean, we're talking tens of millions of vehicles in excess capacity, and they don't want to lay Chinese workers off. The governments there are willing to absorb some losses, but they want to turn the country into a giant export base. That, of course, would be at the expense of everybody making and selling vehicles in the U.S., in Europe, Southeast Asia, where Toyota does a lot of business. So, everybody feels threatened by this. The Chinese government subsidizes its companies in other ways, like free land, paying for factories, funding R&D, and the governments, local and national, own some of these companies, and they're willing to absorb losses while they all go for market share. They're getting subsidies in every way possible, and the foreign governments are saying enough is enough here, and we're not going to just give our car market away to a Chinese export giant.
So why is the EU voting to impose these tariffs now? Bring us up to speed in kind of the context here and the relationship between the EU and China.
Yeah, look, the EU years ago decided diesel wasn't their thing for clean air, and they really pushed for adoption of EVs. And the Chinese seized on that, and they've been growing a lot of market share in all the different European markets within the EU. And that does hurt the domestic companies. Interestingly, with this vote, Germany voted against it, which I thought was kind of fascinating in the sense that this sounds like a very tactical vote by the Germans, because they probably knew that there'd be enough votes to implement the tariff. By voting against it, they signaled to China that they're open for business, and they need that because Volkswagen, Mercedes, and BMW are big players in the Chinese market, and they don't want to be penalized there for what the EU governments are doing.
Interesting. So if I am a Western automaker, whether it's Volkswagen or Ford, David, how do I think about the Chinese market? Is that an opportunity for me, or is that more of a risk here?
Look, it's going away. I think it's a matter of time before the Western companies are mostly squeezed out. I mean, you have two factors at play. One is the Chinese product, the domestic product's very good. So it's tough to compete there. They have a cost advantage because of the subsidies, but also because labor is cheap. Arguably, Western companies enjoy some of that, which is cheap labor, but they don't necessarily benefit from all the government subsidies and money for factories, money for R&D, and so forth. But the Chinese government is increasingly pressuring people to buy domestic, and the product is good. So you're seeing market share losses from everybody. GM's market share is down by a third. Volkswagen's taken a hit. Hyundai's down like 80% because there was tension between the South Korean government and China's government in the South China Sea a couple of years ago. And then suddenly nobody wanted to buy Hyundais and Kias in China. So you see a lot of these domestic pressures in China against foreign nameplates. And it's just tougher and tougher for everyone to do business there.
All right, David, thanks so much for joining us. Always appreciate getting your reporting and your perspective. David Welch, he's a Detroit bureau chief for Bloomberg News. Again, kind of some concerted effort on the part of some of these Western countries in the form of tariffs against Chinese electric vehicles. A competitive market, to be sure, and a developing story, to be sure. Stocks barely hanging on to some gains here. The S&P's up about 8 points. The NASDAQ's up about 62 points. That's 0.3% here. So giving away some of the earlier gains on the back of that strong data print from the labor market. This is
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. JP Morgan Chase, Bank of America now forecasting a quarter-point reduction in rates when the Fed next meets in November, giving up their calls on a larger cut after labor market data this morning offered evidence of U.S. economic resilience. Stocks pushing higher after the jobs report. S&P right now up 12, a gain of 0.2%. The Dow up 51, up 0.1%. NASDAQ up 73, up by 0.4%. Bottom line here, we are off session highs. The Russell 2000 index of small cap shares up now by about 1%. 10-year 3.96%, the 2-year 3.90%. Spot gold down $4 the ounce, 26.51, a decline of 0.1%. And West Texas Intermediate crude is now advancing 1.1%, 74.55 a barrel. So a hotter than expected jobs report this morning. Where does it leave the Federal Reserve? Ellen Zentner is chief U.S. economist at Morgan Stanley, and she was a guest this morning on Bloomberg Surveillance.
Well, favorably. It's, look, there's ample room to cut, to use Chair Powell's own word. And so given that, the bar is not particularly high to go 50 basis points if the data warrant. This is not data that warrant it.
Ellen Zentner of Morgan Stanley, again, the 10-year right now, 3.96%. ARK Investment CEO Kathy Wood will be joining Bloomberg Business Week today, right after the closing bell, to talk AI and her latest investments in OpenAI. You can catch this conversation, going to be a good one, with Carol Massar and Tim Stenovic, 4 p.m. Wall Street time on Bloomberg Radio and Television. Recapping S&P up 13, up 0.2. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate it. Emily Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, and we're streaming live on that internet thing. So go over to youtube.com and search Bloomberg Live Radio, and that's where you'll find the video portion of this program. I mean, again, as Charlie just reporting, a very strong print there on the payroll data. Stocks higher, although they're off their highs of the day. Yields moving higher, particularly on the short end of the curve, where we've got the 2-year up 19 basis points. Wow. How about that, kids? 3.89%. The 10-year, we're on a 4% watch here, 3.96%. Let's talk to somebody who actually gets paid to do this stuff. Brian Levitt, Global Market Strategist for Invesco, doing the Zoom thing from the home office. Good for him. Brian, what do you make of this print, and how does it maybe change or alter or your view of kind of where your clients should be putting money these days?
It's a strong number. These things will get revised, so we do take it with a little bit of a grain of salt, but it's a strong payroll number, and I view that as a good thing. It's, investors had been so focused on inflation. The shift really is now towards the sustainability, the resilience of growth, and so when you get a strong number like this, it's a positive. Now, the markets took it very favorably initially. As you mentioned, some of those gains have come back. That's because interest rates have jumped up a lot. But I still view it as, if you're in an environment where you have resilient growth and less rate cuts, that's still better than weak growth and more rate cuts.
So, Brian, is it fair to say then that the Fed has engineered a soft landing when you look at how the stock market is reacting and also just how strong the payroll print was today?
Well, that's the preponderance of evidence suggests a soft landing. Now, I don't think we can be absolutely certain yet. There's still some weakness. I mean, if you notice in that report, in the payroll report, the manufacturing sector did lose jobs. We've seen some of the purchasing manager indices sitting below 50 for a bit here. But yeah, I mean, the preponderance of evidence still suggests a soft landing and a good backdrop for investors.
So, Brian, if it is, continue to be a risk-on environment, how much risk? Stocks, bonds, credit, treasuries? How do you think about it?
Yeah, so we've been in an environment now where the leading indicators of the economy have actually been pointing to below trend growth, and we needed easing. And so easing comes along and the economy's actually been more resilient. Then yeah, you want to be in stocks, you want to be in riskier credit, you want to be in If you expect growth to pick up, you want to be in cyclicals and value. So it's a broadening picture. If you get the soft landing, as we suspect we will, you should see broader markets than we saw last year. And again, a good backdrop for risk taking.
What does broader mean? I'm thinking about an ETF housed at your very own shop, RSP, that plays, of course, on the equal weight S&P 500. Is that where you kind of see the gains for the rest of the year, or is it better to kind of stay in the market cap, the big tech?
Yeah, equal weight's a great point. So market cap can have long periods of outperformance. It tends to shift towards the end of a cycle when you're going into a recession and coming out. That's when equal weight tends to do well. Now, we've been in this long environment of market cap outperformance. Can we do it with a soft landing? Rather than see a shift with, the market cap outperformance coming with a recession, more along the lines of a soft landing and then a reacceleration in activity. That would be my view. We're starting to see it in some places. Small cap, again, having a very good day today on the expectation of this economy's in good shape. So, yeah, a lot of the reason why the market cap outperformed last year is the market priced in a small cap rally or an equal weight rally in 2 months at the end of 23, and then we had to back out all the rate cuts. I don't think that's the case this time. The Fed is likely to continue to lower rates. So long as the economy remains resilient, then yeah, equal weight should outperform.
Brian, you're a global market strategist. So how do you think about the U.S. versus rest of the world?
It's a little bit of a challenge here in the short term because the dollar strength. And, what you would want to see is U.S. growth differentials moving back towards the rest of the world, U.S. interest rate differentials moving back towards the rest of the world. Today's report threw a little bit of a challenge to that because, U.S. growth continues to look quite good and interest rates may remain higher than many had thought. And the dollar's moving up pretty significantly. So that's a little bit of a headwind to capital flowing around the world. Now, you play this out over the next few years. The Fed goes through its easing cycle and rates starts to come down. Rates do come down. The dollar should weaken some, but in the short term here, this is a report that's more favorable for U.S. assets.
Okay, so we did stocks, we did FX, we have to do bonds as well, Paul. So, Brian, we're seeing a really large spike up in yields today in the U.S. How are people making money in bonds?
Well, remember in 2019, investors were begging for 4%, and so it's back again today. In 2019, the answer to the question, how do you get 4%, was, well, lend money to the Russian government. And a lot of people weren't willing to do that. So today, you can lend money to U.S. corporates, the U.S. Treasury, to U.S. municipalities, and get these nice yields. Now, the total return story may be a little bit behind us, but the yields are there for the taking. And if you're sitting in money markets, remember those yields will likely come down over time. So there is reinvestment risk. So it's still a very good opportunity for income investors to lock in the types of yields that they were begging for 5 years ago.
Brian, your offices, are they down in the World Financial Center?
They are.
So that begs a question as a Jersey guy. Ferry or Path?
It's the Path.
Oh, man. There's a cost-conscious guy there because the ferry's a lot more expensive. But it's
well, no,
it's fun.
It is. When you live in New Jersey, though, you get on you park at the first station you can, and for me, that's Harrison. There's no way I'm driving all the way to the water.
Very good. All right, Brian, we got that down. Brian Levitt, global market strategist at Invesco. He is a Path guy. Good to know. When you talk to these Jersey guys and they work downtown, you got to figure out how they get across the river. I, on the other hand, was a ferry guy because it's because and then every night at home we took a car home.
It's a lot of fun. I often take the ferry from. It is more expensive if you go from Manhattan to Brooklyn.
Yes.
But I just like to romanticize my life a little bit.
Well, I'll tell you, the ferry, now they live down the Jersey Shore, the ferry down to the Highlands where John Tucker lives, that is a good voyage there. So we're looking at the markets here. S&P 500 up 10 points. The NASDAQ up 63 points. That is about 0.3% gain. We'll have more coming back. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, folks, it is Hispanic Heritage Month, and every day at this time, we are celebrating significant moments in Hispanic heritage. Now with your installment for October 4th, here's Bloomberg's Lisa Mateo.
All right, so in this month in 1961, one of my favorites, the film adaptation of the 1957 musical romantic drama West Side Story, it was released. Love that song. Okay, it's regarded as one of the greatest musical films of all time, winning the Academy Award for Best Picture, being the highest grossing film in 1961. West Side Story, though, it illustrated a lot of the struggles that Latino immigrants faced. It's also one of the earliest depictions of U.S. Latinos on stage or film. It boosted the profile of Puerto Rican actress Rita Moreno, who I love, won the Oscar for Best Supporting Actress in a role as Anita. There were a few stereotypes of Puerto Ricans within the film, but the cultural impact, the significance it marked for the Hispanic community, really something worth remembering. That's this month in Hispanic Heritage. Lisa Mateo, Bloomberg Radio.
Yeah, that was a great one. Fantastic score and everything. Great dancing. Good stuff there. We appreciate it. Lisa Mateo with that Hispanic Heritage Month moment. Deal potentially in tech space. Cisco they agreed to invest in CoreWave, a cloud computing provider that's among the hottest startups in artificial intelligence. And guess where this company is based, CoreWave? Roseland, New Jersey, another New Jersey company. That's no surprise there. Woo Jin Ho joins us. He's a Bloomberg Intelligence senior technology analyst. Wooj, tell us about what this company, CoreWave. What are they? Why are they attractive to the Ciscos of the world?
Yeah, hey, Paul. I'm also a Jersey guy, and I'm a Ferry guy as well. But to start with CoreWave, these guys are what we call a neo cloud, a next generation AI cloud. So, for example, what they're trying to do is go head-to-head with someone like an Amazon Web Services or Microsoft to provide large language models or AI services to customers like, let's just say, a Bloomberg or a bank or even Microsoft, for that matter, for some of their large language model training overflow.
Wooj, is that Mr. Met on your shirt?
Polar bear all the way. Let's go Mets.
All right, he's got his Mets shirt on for our folks on who looking at it on YouTube as well. All right, so is this an example here or a situation where if I'm a big, I'm going to say legacy tech company like a Cisco, and I see this OpenAI thing, do I buy my way into this market? Do I buy my way into the exposure to this market? Is that what's happening here?
And that's a fantastic question. I think what they're trying to do is hedge themselves so they don't lose the market. It's only an investment, Paul, and not an acquisition. And I think